In this episode, we continue going through Nelson Nash's book, Becoming Your Own Banker, which is the foundation for the infinite banking concept. Enjoy this episode.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm your host, Cameron Christensen, along with our co-host here, Anthony Faso. Anthony, welcome.
Looking forward to another podcast as we dive deeper into Nelson's book, Becoming Your Own Banker.
Absolutely. Before we get to that, I wanted to share a little story that happened to me this week. Is that all right?
Sure, yeah.
Cool. The reason I want to share it is because at the beginning of every podcast, and usually at the end, we've got kind of a call to action that says, hey, give us a call if you guys have any questions. And last week I spoke with a gentleman that finally called in. He's been listening to the podcast, and he called in and he said, hey, I've got some whole life policies and I want you guys to take a look at them. And I started looking at them, and the first thing that jumped out at me was the design of the policy.
What do you mean by design?
Yeah, good question. Is when we're talking about whole life insurance, the stuff that we're using is designed differently than what everybody else typically has. And so when people just go in and they talk to an advisor and they say, hey, I want to buy some whole life insurance and I need it for X, usually it's death benefit coverages, it's not designed the same way. And so as we go through this chapter, the reason I'm sharing is because as we go through this chapter, we're going to start talking about design and some of those things. But this gentleman called me up. He had two policies that he had purchased within the last year, and his total premium was about $30,000 a year. And Anthony, do you have a guess as far as how much cash value he had out of after paying the insurance companies $30,000 in premium?
Well, you're kind of setting it up, so I'm assuming very little.
He had very little, zero cash value. So that is the exact opposite of what we're trying to do here and what we're trying to accomplish. And so the policies that I own, the policies that Anthony owns, the policies that we put in place for our clients are the exact opposite. They're very cash value rich. They have high equity, high cash value. And we do it for the reasons that we're going to start talking about in today's podcast. Is people have a need. Their need for finance is greater than their need for death benefit. And so when we design policies, is you can only have one of two things. You can have a high death benefit and low cash value, or you can have high cash value and low death benefit. And 9 times out of 10, what people have is they have a really high death benefit and very little cash value, unfortunately. So I just want to share that with you. If you guys have a policy, you guys want us to take a look at it, man, reach out to us. Both of our contacts are in the show notes, and we'd love to talk to you and take a look and help you out in any way we can.
Perfect.
Yeah. Awesome. Let's get started. I'm excited. We're going to dive right into Nelson Nash's book, pick up where we left off after our last podcast, and we're going to start on page 17. Page 17 is called The Problem. Anthony, in your opinion, or I'm not sure, in your opinion, or what are your thoughts on this part of the book? It's about 2 pages long, but there's a ton of information in here.
I thought, each chapter is interesting on its own, really. I mean, we could spend a lot of time diving into this, but in where he talks about the annual pattern of spending, and what he had was a 29-year-old who made $28,500. You know, one thing that bugs you, he doesn't like to round.
He's very specific.
Like, why not 30,000?
That bothers
right?
you? I thought you would appreciate it. You're a CPA numbers guy, right? Down to the penny.
Remember, I'm a recovering CPA.
That's true.
But what he had, this individual, his after-tax income, he was spending 20% on automobiles, 30% on housing, 40% on living, and saving 10%. To be honest, when I first looked at that, those numbers seemed a little off. I mean, do you really spend 20% on automobile or 40% on living? But when I actually put some numbers to it, 28,000, living expenses is $40,000. 40%, that's $11,000 for 100. So that's $1,000 a month. So putting in those terms, it made more sense. But the bottom line is, well, he also gave people the benefit of the doubt that they're actually saving 10%. Mm-hmm. And I know you're big on this, and you know the number. or at least I'm putting you on the spot.
I absolutely know the number.
What's the average savings rate?
The average annual savings rate in the U.S. has fluctuated over the years, and it's usually right around 5%, if not a little bit lower. And if you look it up, it's kind of got an inverse relationship to how well the economy is doing, which is kind of funny. If you go back and you look at the years in which the economy was doing well and people were making money, that annual average savings rate decreases. And so in 2007, 2008, if you look at the numbers, there was a period of several months there when the savings rate was negative. That means that people were spending more money than what they were making. And so if you look at overall, it's usually about 5% is what people save.
Well, so Cameron, you're saying when people are doing well and they're making more money, they're saving less.
Absolutely. It's psychological. When you're doing well and things are going well, you think this is never going to end.
And I think that's the point of what that reiterates what Nelson talks in this chapter is called the problem, right? That doesn't make sense.
Yeah.
Right? That should be the time of harvesting, in the spring and saving for winter.
If you think about it, the silent generation, right? Our grandparents, the ones that kind of experienced kind of the Great Depression or were around kind of at that time, those are the ones that have that instinct to save. They're the ones that have saved all the money. And if you look at it generationally, they're the ones that still have all the money. Grandma and Grandpa have it all, and now we're just trying to help clients plan for that generational wealth from one generation to the next. Sorry, that was a tangent.
No, that was good. And again, to the numbers, when you kind of carved out how much interest, 34.5% was going to interest.
Yeah.
Like that to me is mind blowing. Like a third of your take home income is going to banks.
You know what's funny is when I've shared that statistic with people, is they don't get it. It doesn't resonate with people. I don't know if they just don't believe it, or if it's just a number that just kind of hard to wrap your head around.
What I think most people don't view their mortgage payment as interest.
I'd agree. Actually, you know what? I'm going to disagree with you there.
How come?
Well, I don't want to...
Outside before tax time when they get that 1098 and they want to deduct it.
Well, I was going to say it's usually... So I'm just going to talk about my experience here, and I don't want to jump too far ahead, but Nelson, when he's on page 17 at the top of the page on the right-hand side, is he introduces cars, and he's saying, hey, when people finance their cars, they're spending 30% of their income. And this is when he brings up the idea of volume versus rate, right? Mm-hmm. And he brings this idea up when he's talking about cars. The way that the most success that I've had over the years when I've brought this up to people and explained the difference between volume and rate is when I'm talking about their house, right? And I say, okay, listen, what's your interest rate that you pay on your home mortgage right now?
Like 3.5, something like that.
Right, 3.5, 4, 5, whatever it is. And I say, okay, well, that's your interest rate. I go, if you own a $300,000 house and you finance that for 30 years, what's the volume of interest that you're going to pay over that 30-year period?
About $300,000.
Absolutely, give or take several tens of thousands of dollars. It's usually double, right? It's kind of the general understanding. And when presented to people that way, they understand it. And that's the difference between rate versus volume. And I have a bias. I kind of always tell people that when people are talking about rate, whether you're financing a car or financing your home mortgage, it's kind of smoke and mirrors, right? Is they want you to focus on that rate, but really they don't ever bring up the total amount of volume that you're paying in interest. And so one of the things that I know you've done this in your career that I've done in my career is I call that level one is the rate. What's the interest rate you're paying? Yeah, we want to get the best rate, but in reality, we need to also dig deep and go to level 2 and look at the volume of interest that we're paying on, whether it's your house or your car or credit card debt, anything like that.
Yeah, no, the old saying goes, when you get a mortgage, you buy one house for you and one house for the bank, because you end up paying about double in interest. Man, I was going to do something good. I had a good tangent, but it will come back to me.
All right. One of the things that I always, when we present in front of groups of people, is we have this annual pattern of spending typically on one of our slides. Mm-hmm. and you kind of put it up there, and you put up the cost of the cars, the housing, the living, and then the savings, and we take away the cost and we just isolate the interest, and you've got 34.5% of their income that's going to interest, and they're struggling to save 5, but Nelson gives them credit for 10, so double. So the scenario, the ratio is 34.5% of their income is going to interest, and they're struggling to save 10%.
Mm-hmm.
One of the things I always tell everybody is, man, it does not matter who you are, you will never get ahead with those numbers. 34.5% going to somebody else to sustain your lifestyle, and you're struggling to put away 5 to 10%. I'm going to keep on going.
Well, no, why don't we go into the airplane example, and then that good nugget is better than I thought, but
Okay.
I wrote it down. So.
Did you? Okay, well, let me finish
Go
this
ahead.
thought, because this is good, is because this is also one of the things that I tell people, that how we're different than everybody else, right? Is because when most people, they come in and they approach us and they say, hey, I want to do some sort of planning, right? For, I'm starting to save money. I need some suggestions. I need some advice. Almost to a T, every single one of them comes in, and what are they talking about? They're talking about that 5% that they have that's going to savings,
Mm-hmm.
right? And so I'll say, great, we can absolutely help you with this 5%, but really what's going to distinguish us and some of the strategies that we use is putting strategies in place to go after and recoup that 34.5% and start to move that over to the savings column, right? And so that's kind of what separates us. Is most advisors, you walk in there and you say, listen, I want to start savings. They say, great, give me your 5%. I'm going to go stick it into this account, and that's the best thing I can do for you.
Yeah, I said, like, if you are meeting with a typical financial advisor, they're going to say, oh, you know what, I could earn you a higher rate of return on really savings may not, I don't think is a proper way to describe it. It's more of their investing, because savings, you should not invest savings in the stock market. Maybe at some point we're kind of distinguish the difference between defining savings and investing.
Mm-hmm.
But typical financial planners say, look, I can earn you a higher rate of return. Maybe they can, right? But with a higher rate of return, don't you need to take on more risk generally to earn a higher rate of return?
Absolutely.
And in this economy, in this situation, how many people really want to take on more risk? And one person could believe me, when I was going through the weeds, I was deep in the weeds, man, when I first got my policy. And one way he framed it to me was, would you rather earn 10% on your savings, or would you rather earn 4% on your income?
Mm.
And at some point, we will dive in the book of how premiums equal income, which is it's not an easy task, and it takes some time. But the bottom line is, and really, and we say this all the time, that this is an and asset. If somebody says, "Well, I could earn a higher rate of return," awesome. Why can't we do both?
Yeah.
Right? Because I know we're getting. You finance everything that you buy, and that includes investments as well. So, a lot of times we can use the policy to help that 34.5. There's also ways that we can manage it to take on even more investing. Mm-hmm. So, like, these here we call expenses, and expenses is money going away from you. And we do want to limit that as much as possible. Once we do, then we need to start buying assets. And assets is money coming to you.
Great analogy.
And thanks.
Before we flip the page, because we're kind of covering page 17, one of the things that I appreciate that I identified within this book is he's got some scripture that he throws in throughout this. And in the top left, he kind of starts this paragraph by saying, when Jesus saw him laying there and learned that he had been in this condition for a long time, he asked him, "Do you want to get well?" That right there, for some reason, has always resonated with me. And this is my original book that I had. And right underneath it, I wrote in pencil, "Not everyone does."
This is, you brought up a good point here. I mean, I don't know how we've read this book. I mean, many times, maybe 50 or something. But
I read it 51.
Actually, I think 52 or 3.
I read it last
but-
night.
But every time you read it, you pick up something different.
Yeah.
And that's a good point. Do you want to get well? There's people out there who don't want to get well. But I would say that those people, they're not listening to this podcast.
No, I would agree with you. But it's, man, it's one of the most frustrating things that I think I've had in this career is sitting down with somebody and seeing somebody in a situation similar to this and knowing that we can help them and get them out of this situation and presenting that option to them and having them choose not to do it. And the reason, right?
That's what I was going to ask you.
Yeah, I was going to say what I hear from them is typically it's a response of A, I don't understand, or B, so-and-so's not doing this.
I think it's I think it's both and probably mostly the latter.
Yeah.
Like not everybody else is doing this. A prime example, I got a very long email from somebody who found me on YouTube and was like, hey, I want to do IBC. I know that I don't have any liquidity. If his only liquidity is taking a 401k loan, and the most he can do is $50,000.
Yeah.
And that's really is not that liquid. We did the 15-minute call. We went through his goals. He wanted more liquidity. He wanted to create passive income. And in his long email, he's like, I have all this money in IRAs and 401ks. I'm wondering if I should pull it out or not. And I think that's a good topic for a podcast as well. But the bottom line, I said, well, let's look at your goals. Your goals are creating more liquidity and creating more passive income. Can your IRA or 401k do that?
Mm-hmm.
He's like, no, it can't. So we set up another meeting, and but I'm meeting with him tomorrow, so we will see how it goes.
Ooh, to be continued.
Well, no, but so what he said, he goes, hey, Anthony, my wife and I talked about it, and we determined that IBC is not for us. And he was respectful and says, look, we have this meeting. Maybe we should cancel it. My time is valuable. But honestly, I'm going to get some value. I just want to know how he came to that conclusion.
Sure.
I'm not going to try to talk him out of it.
Yeah.
We don't want to convince people to work with us, but I want to get in the more of the mindset of just like what you're talking about.
Yeah. Awesome. Let's flip over to 18. I really like page 18. The reason I like page 18 is because this is where Nelson brings up the plane or the airplane analogy. So what Nelson on page 17, what he's talking about is he's talking about this ratio, and this ratio is that the average person is sending 34.5 cents or 34.5% of their income to banks and interest, and they're saving 10. And if you look at that in a percentage wise, it's 34.5 to 1. And he makes this analogy and compares it to flying a plane, and he calls the plane, or he says the plane filled up with fuel and flying for you in the direction that you want to go. The plane is traveling at 100 miles an hour, right? Mm-hmm. That's your 10% that you're saving in income. On the other side of it, he says if you're paying 34.5 cents of every dollar in the form of interest to banks, that's like having a 345 mile an hour headwind when you're flying in a plane that's going 100 miles an hour. And what he does is he talks about controlling the environment, and his analogy is that there's a storm. The storm is moving counterclockwise, right? We've all seen that kind of on a weather map. Mm-hmm. And so in scenario 1, he's talking about taking that plane, getting off the ground, flying 100 miles an hour into a headwind that's 345. In the book, he talks about taking a plane from Birmingham, Alabama to Chicago, Illinois. And I don't know this for sure, but if you look at a map, I believe Chicago's like due north of Birmingham. But anyway, so that's the analogy he makes. And the question that he asks is, Anthony, right, is if I'm in a plane flying 100 miles an hour into a headwind of 345, how quickly am I going to get to Chicago?
You're not. You will be going backwards.
So what is the best solution at that point?
One thing, let me just add this, in the example that he uses, you're be going backwards. So you're be in Miami before you're be in Chicago.
Yeah.
You know what the abbreviations for Miami are?
No.
MIA. Right? So you're not going to get where you want to go, or who knows where you're going to be MIA if you're flying into a headwind.
Great. That was very clever. Yeah, that was good. That was good. Perfect. So that's kind of scenario number one, right? That's where what he's talking about. Most people, I can't say most, but a lot of people are in that scenario, right? They're trying to get ahead in life. They're in that scenario, flying directly into a headwind, and they're never going to get ahead in that scenario, right? So the best option you can do is land the plane, get out, and start walking. And then we got one other scenario, right? So if we're still using an analogy of kind of this high pressure, low pressure thing that's moving in a counterclockwise direction, if we were to fly kind of through the middle or the eye of the storm, Anthony, typically, I know you're a big meteorology buff, right? If you're flying through the eye of the storm, how much wind is typically in there? Is there much wind in the eye of a storm, Anthony?
I'm going to say very little.
There's very little,
right? Okay.
Right, and so you pass. Congratulations. So the eye of the storm, the second scenario that Nelson brings up in the book is that you're flying in this plane that's going 100 miles an hour. You're flying through the eye of the storm, so you have no headwind. So you're flying from Birmingham, Alabama to Chicago at 100 miles an hour. And one of the problems is that people believe that this is the best case scenario.
Yeah.
Right? And so this is, I'm going to pick on somebody here, Dave Ramsey. Right? This is like Dave Ramsey's mantra is, oh, no man, nothing, have no debt. And that's good. That's great. But we're going to talk about the other scenario here in a second. But this is not the best place to be. Right? We're flying in a plane that's going 100 miles.
It's better.
It's better,
right?
absolutely.
It's better than going backwards.
Absolutely, but it's not the best place. When people typically get in the scenario is... the analogy is that when people are trying to fly, or they're in this scenario where they're flying 100 miles an hour, their focus then turns to the plane.
Let's go faster.
Let's go faster. How do we get a plane to go faster, Anthony?
We have bigger engines.
Bigger engines.
We mean like a higher rate of return, right?
Yeah, higher rate of return.
We need to earn more. We need to move faster.
Exactly. We start stripping weight off the plane, right, to have it perform better. And so then you start to put pressure on this plane, to put stress on the plane and stuff. And so that's the analogy that he's making is when people don't have any debt, they try to squeeze out an extra 1 or 2 miles an hour of performance in this plane. They're missing the point. And I love this analogy is because what Nelson again talks about is that's not the best position. The best position is then to move over again, one position to the left, which is now we've in a position where we have that tailwind that is now at our back. So now we're in a plane flying 100 miles an hour from Birmingham to Chicago, and we're moving 100, but we also have a tailwind of 345 miles per hour.
Right, so we're still saving or still earning the same amount of money, but and really, how much harder is the plane working?
Not harder at all.
Not harder, but it's going 4 times as fast. Or instead of going backwards 345, going forward 345.
Yep. This part of Nelson's book really resonated with me when I first read it. And the reason that I believe that it resonated with me is because on page 18 on the right side, right in the middle, he says, everything you do in the financial world is compared with what everyone else is doing. For me, I try really hard not to compare myself to somebody that's 5 years, 10 years older than me, 15 years older than me, Grandpa. But I absolutely compare myself to what everybody else in my age group is doing. I'm a very competitive person, right? I always try to play it off like I'm not, but I'm very competitive. And so when I read this piece of it, I saw this as an opportunity for me to get ahead and to perform and to be more efficient than everybody else that I know. And so I was all in. I was ready to go after reading this. I love this analogy.
What I like about this analogy is that really, in regards to the plane, is we just can't take off right away. We need to have a plan and a strategy of when we're going to take off at the right time. We take off too early, we're going to go backwards, right? So we need to be very strategic on when we start moving the plane and how. And I think that's also an analogy with people's finances. As soon as they want to take that plane, as soon as they get the keys, Are there keys on the plane? I don't know.
I think so.
I don't know. But let's just say there are.
Yeah.
There's got to be some sort of device, or at least a door key. But as soon as they have the ability to get in a plane,
Keys to the hangar.
yeah,
Yeah.
they want to take off and go flying. But if they do it too soon, they're going to hit the headwind. So we need to make sure that we have our equipment all in order, and we have a good flight path and a good time. And that also means we need to make sure that our finances are in order. Before we start investing, going for that home run, we need to make sure that we've had some batting practice and that we're warmed up. And so when it's game time, we are ready to rock and roll.
Absolutely. Page 18. And he says, right, if you've ever wondered, he didn't say this part, but he said, if you've ever wondered kind of what Nelson's book is about, on page 18, right above the last paragraph, right in the middle, it says, quote, that's what this book is about, creating a perpetual tailwind to everything you do in the financial world. Think about that for a second. The way that I typically communicate that idea to clients is I always say it's an and asset. Mm-hmm. Right? I think we've said it before on the podcast, but that's the default way that I communicate it is, hey, we're going to do real estate and we're going to do banking, right? Or we're going to banking, which is our policies and those things. We're going to do banking and real estate, or banking and our business. And so that's the way that I've always communicated to you is, to clients is, but it's creating that perpetual tailwind to everything that we do.
And one thing I think he mentions here that he talks a lot about, and really we're going to see the first half of the book is all about really how you think. He doesn't get in the numbers until halfway through. And a lot of it is people need to use their imagination. Mm-hmm. And a lot of people don't know what they don't know. All they think is that their only option is investing in the stock market. But there's a lot of other ways to build wealth. And really, you look at the wealthy people, they don't do that by maxing out their 401k. They're really doing it in the 5 pillars we've talked about, right? Which is having the foundation of cash value, safe place to store cash in life insurance, starting their own business, investing in themselves, in lending and real estate. That's where people build true wealth.
I totally agree with you. And right? She said perfect under your breath.
Yeah.
The second to last paragraph again, it says, it never dawns on most financial gurus that you can control the financial environment in which you operate. Perhaps it's caused by lack of imagination, but whatever the cause, learning to control it is the most profitable thing you can do over a lifetime. Right? Man, there's financial gurus all over the place, and to continue with that analogy, when they're talking about squeezing an extra mile or 2% out of your IRA or something like that, right? The analogy is the airplane is, man, I tune out, right? I mean, that is not going to get me to where I'm going. The biggest opportunity that we have in the financial world is creating the environment in which we're operating in.
Yeah, and add on to that, and I wouldn't call a typical financial planner a guru, but let's just give them the benefit of the doubt.
Yeah.
How many of them really know what about IBC? I mean, maybe they're life insurance license.
Well, it goes back to kind of how I opened this podcast, right? As a gentleman wanted to get started with this concept. This concept is bigger than the product that we use, right? But he went in there and said, hey, I want to start this. And he got something else in return because the advisor didn't have an understanding of what we're trying to get.
Because I know you told me the story about this before, but if I remember correctly, he was listening to IBC and he wanted an IBC policy, but he went to somebody who wasn't an expert in IBC and says, "Hey, I want a life insurance policy and my premium's $30,000." They're going to design it, just as you said, to maximize cash value, to maximize death benefit. And the way we do it is the opposite. Mm-hmm. We do it to maximize cash.
Absolutely.
The one little thing that I forgot, but fortunately came back to, was we were talking about rate versus volume.
Mm-hmm.
And Nelson used the example, if you're getting a shot, like the rate is like the speed of which you get the injection.
Mm-hmm.
Like, what's more important, how fast you get the injection, or the volume, or the amount of medicine that you get?
I have seen many episodes of Grey's Anatomy.
Okay, so you're an expert.
So I am an expert, and I know that the volume or the cc's of the medicine is more important than the rate at which it is determined.
Right? Not enough.
Yep.
It doesn't help. Too much, it can literally kill you.
Yep.
And that's what I tell my clients when they're focused on rates of return. Until I can buy, or until I can make my mortgage payment, or my doctor will accept a copay, or I can put food on the table with a rate of return, I'm not focused on rates of return. I can only do that with cash. So at the end of the day, we're trying to build wealth to create passive income to create our lifestyle or to create a legacy. We can't do that with rates of return. We need cash. So when we're measuring something, I wouldn't focus on rates of return. Which one is going to provide the more cash? And I think a prime example on this is people who are flipping real estate, which is really big right now.
Mm-hmm.
And we have some friends, and we did a webinar with Ryan Panetta before. What's the name of his company? But Home Run Realty. But he has a book called Flipping Your Future that goes into how to flip properties. It is a very good book. I mean, it's very easy to read, and he's a good guy. But a lot of times when he's buying a property, he's using a hard money loan, which in essence is not going through a typical bank. It's going directly to a lender. To typically an investor, and he's going to pay between 10 and 12%. And most people think 10, 12%, that is just way too much money.
Right.
But what he's looking at is he sees a property at a low price, and he knows that he can do some improvements, and there's going to be some costs, and part of that's interest. And he calculates that in there and trying to figure, okay, when I sell this, how much profit am I going to make? So he's looking at the end of the day, how much volume or how much cash is he going to make on this deal? He's not focused on the rate of return that he's paying the lender.
I'm glad they came back to you. That's a great analogy.
Thanks again.
Absolutely. Anthony, you got any other nuggets you want to share with us?
I do, but I'm going to save them for later, because we are diving deeper into these books, and we're going to start getting into some fun stuff. And as we start talking about some of the human factors, that to me is going to be really fun. I think we may do that in a couple episodes, but I'm looking forward to that one.
Yeah. Next episode, we're going to be diving into page 19, creating a bank like the ones you already know. So we're going to be talking about banks, how they work, how they create wealth, how they tell people they should be creating wealth, and what they do differently. I really enjoy this chapter of the book, and so we'll do that next time. But if you guys have any questions, again, down in the show notes, there's a link to Anthony and myself. We'd love to have a quick 15-minute conversation with you to answer any questions, or even just to, if you want to send over your policies and have us take a look at them, and we can give you some input on the design on those. So, again, thanks for listening.
Go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.